Welcome. Now, I want to piggyback off the last video we did talking about what is the best time frame to trade on, and that was the daily time frame. In that example, we went over CHF JPY and how we could use the daily time frame to find great opportunities to take a day trade with massive pips. So you could have a huge take profit and a pretty tight stop loss using what we're going to go over today. On here, we have this trade, this NZD CHF trade, which is the next one right after CHF JPY. We're just going to go through them. We're going through the back catalog. We're just going to go over this. This is what I think gives you the best benefit to you. You can see actual trades that were taken, the mindset, and how I approached it, and you can use that to progress your own strategies if you see something that fits you in this video. But we have this buy limit NZD CHF 6456, stop loss 6434, take profit 6522. Here it is on screen. Make sure everything match. Yep, nice and easy 3R risk to reward. So let's go over it, man. The daily time frame. The daily time frame is so beneficial to trading in general. I use this time frame most often when I'm looking to analyze a pair. I'll look at the daily time frame and get my analysis for a general perspective of the market on the daily time frame. It's going to give you the most information. Once the daily candle closes, it gives you all sessions, all markets, and all the participants for that day. It gives you their opinion. So you can see whether the market was bullish or bearish, or has been continuing to be bullish, or has continuing to be bearish, or currently consolidating. You can see what the big players in the market are thinking from the daily time frame. So if we do what we always do, let's go over this trade using multi-time frame analysis and structure the right way. We can go on the monthly, which is not needed, but we can go on the monthly. We can see that we're breaking structure to the upside, found level of resistance here, broke it to the upside, coming back for a retracement, previous structure resistance, now being used as support. Same thing over and over and over. If we drop down to the weekly, what can we see? We've had this sort of downtrend, but it is a pattern that a lot of people know as a falling wedge. So the market is just slowly progressing to the downside, waiting for a break to the upside. And that is what we're looking for on the weekly. We're starting to get our push with this candle here, starting to get a push to retest some of the previous highs, structure resistance right in this area. So we're just looking for more continuation to the upside. Now, if we do go down to the daily time frame, where we're going to focus a lot on right here, is that you can see it's just the simple market structure, the way the market works. If it wants to move to the upside, it has to create higher highs and higher lows. The market, if it's going to move to the upside, 99.999% of the time will not come back down to break these lows to create a higher high, and vice versa. On the downside, the market is not going to start making moves to the downside, creating lower lows and lower highs, and then break these highs only to create a lower low. That's too much money in the market. It's just not something that happens often, if ever. So I'm not going to say it doesn't happen, but it doesn't happen as often as normal market conditions. So we just want to see a higher high created. What can we identify on this market right here and right now? We've had previous structure resistance right in this area. It's been resistance once, resistance twice, resistance thrice, resistance a fourth time, and then we finally got the break above this area, break and close above. And once we did get that break and close above, we created a higher high, coming and retesting previous structure highs and resistance right in here. So we can't move in one direction forever. The market can't go in one direction forever. If it wants to move up, it has to retrace to the downside for a little exhaustion in order to create a higher high. Now, you can use a multitude of things. A lot of things work. You can use your Fibonacci. You can use a trend line. You can just simply use market structure. But for me, this area right in here, in between the 50 and the 618, is really, really good for finding places where the market is going to stop the retracement and continue the impulse. So once we got this tap into this area, and this was on this bearish candle, once it came back down to the 618, 50% retracement zone, the retracement stopped. And then the next day was when this candle was printed. So the next day after this area, all the market participants within a day decided that this market is going to be a bullish day and looks like it's going to start the continuation to the upside. So that's exactly what we want to see. We know the market moves up to the upside, creating a higher high, coming back for a retracement, then creating a higher high, coming back for a retracement, most likely retesting previous structure resistance on this side and having it act as as support on this side in order to see the market continue its trend. So we've gotten that perfectly. We've got a 618 50% retracement right down into this area. We have previous structure support and resistance. Even if we extend this out in here, we can see that we did find some support when the market came in this area. We had a bounce, then we came back down in this area again. We did have a little bit of consolidation, so this is a pretty strong structure area. We have this structure area in here that was broken to the upside. Market came back, retested it, and has now started the continuation to the upside. Just purely speaking about day trading. Day trading, in the essence of the word, when it pertains to the Forex market, trading, stocks, anything, is you're just trying to capitalize on the move of the day. If you're day trading, you want to get as much as you can out of whatever you're trading, but you just want to be in the right direction, following along with the big market players in the market at that time. So I see a lot of people that claim that they're day trading, but they secure 10, 15 pips. Most pairs, if not all instruments, are going to move a little more than 10 to 15 pips in a day that you're able to capture, if you're doing it the correct way, of course. So I just want to say that, no names, but if you're saying that you capture 20 pips, 15 pips in a day on a trade, that's not day trading, that's scalping. Nothing wrong with it. It is a little more higher risk, even if you have a favorable risk to reward and a good strategy, just because it's so many opportunities for you to lose in the market. But if you're purely day trading, you just want to capitalize on the move of the day. So you want to be in the intended direction that the market is going so you can make as much as possible. Now, my day trades are, as you can see, we've had 65, 66, we've had 30, we've had 100, we've had 200 pip day trades. It's all the same. It comes down to this. We're looking at the daily time frame. So for the next days, I intend this market to continue to the upside, creating a higher high. I expect that this market is going to make this move to the upside for the next few days. So that eliminates me having to go back and check and worry about what this trade is looking like on the 1 hour, on the 15 minute, on the 2 hour, 30 minute, whatever 5 minute time frame. I don't really need to look at it or pay attention to what is going on those smaller time frames, because I know my higher time frame is telling me it's going to keep moving to the upside. I expect this market to break structure to the upside and continue trend. So let's get right into how we got into this. If we go down on the 4 hour time frame, so we bounce back from the daily, we're starting the impulse to the upside. How can we take advantage of this move? If we do go down to the 4 hour time frame, we can see that right in this area, let's keep these charts clean. Right in this area, after we had this retracement, we started to change market structure. So we were creating lower lows and lower highs, lower low, lower high, lower low, lower high. We failed to create a lower low and then broke structure to the upside, creating a higher high. After a higher high, what do you expect? You expect there to be a higher low, and then from there, higher high, higher low, higher high, higher low, especially when your lower time frames are lining up with your higher time frames and your higher time frame bias. So we're looking pretty good as far as the intended direction of this market. As well, as you can see, after the market came back into this retracement area, you can see how these candles started to increase in size as well, and velocity. So they started to get a little bigger, the bullish candles did, versus right around in this area when it was consolidating, finding the support, started to get a little bigger candles on its movement back up to the upside, as well as with a lot of more volatility. So that's just a better indication that we are headed in the right direction with this trade. Now, we can't just get into this trade just because we intend it to go up. We're just going to buy and just hope it goes up. No, there's an actual strategy that we use over here. I can't give you all the details and intricacies of what goes on along in the strategy. If you would like to know that information, check the link in the description. It'll probably be the first pinned comment as well. Basically, you can see that we've had previous structure resistance right in here. So we waited until we had previous structure resistance right in here. And once broken to the upside, we expect it to be previous structure support. Same thing on higher time frames, lower time frames, entry time frames. It doesn't matter. We still do the same thing, keeping it consistent, because that is how we gain profitability. So now that we've had this structure break to the upside and we look like we want to go ahead and make this move to the upside, we want to just catch along and get caught in along for the ride with the big market players and the market participants. So what did we do? We put our entry right here, previous structure resistance, that if tested, and probably should be tested, will be acting as support. We have our stop below the low of our entry time frame, so right here on the 4 hour. And then we also took our target from a higher time frame, from the daily time frame, and we were looking for a higher high to be created, following the rules of the strategy. Once we had all those rules satisfied, we then place our entry, place our order, and we just sit back and wait. We let the market do what the market wants to do. We can't control it, can't make it go in either direction. direction. So the only thing we can do is just wait. Now, if we play it out, you can see that we bada bing, bada boom right here. We get the perfect retest right in. You all like to call it sniper entry. Little to no drawdown, barely right around our entry for a few minutes, if that. I mean, you can see it on the 15-minute, tapped in on this 15-minute candle for probably a few seconds, a minute or two, and then started to pull back and make its move to the upside. So once we are triggered in this market, the only thing left to do is let it hit the target. We're not risk-free yet. The rules don't say go risk-free yet. We can let it play out a little more because we do get the retest once again. It starts to pull back a little bit, and you can see that the area that we drew out, previous structure resistance, should be acting as support in this area, is doing just that. The market is having a hard time breaking below this level and continuing below this level. So the only thing we are left to do is just to hold this market. You can see that it gets close to the stop loss, but once again, I've said it once, I'll say it over and over again. We put the stop loss where the stop loss, it has to go. It has to go where it has to go. If we can't get our stop loss where it needs to go with a favorable risk to reward, then we don't take the trade. But the stop loss has to go where the stop loss needs to go, which is either below or above structure. Because if it's hit, you don't want to be in that trade. It's telling you that your idea is wrong. And as well, if you get it any closer, even if you're not wrong, you could get stopped out and have the market go in your direction. So we want to give our trade as much possibility in order for it to confirm what we thought was going to happen in the beginning of the trade without getting stopped out prematurely and then watching it play out exactly as we want it to. So you can see that we have now came back, retested this area. We almost hit the stop loss, came pretty close, and then started to explode to the upside. And then from here, you can see the market just starts to make moves to the upside, risk-free on this trade. And then once we are risk-free, price just explodes to the upside for a nice 66 pips. 3R take profit on NZD CHF. It was pretty easy to sit through. There wasn't really too much to do other than to let the market play out. So that's it, man. That's how you day trade, finding pretty massive moves with really favorable risk to rewards, finding 3R day trades for 66 pips in a day. It's just crazy, man. You know, a day or two, it's just crazy. So take what you can from this, take the information that you can from this, use it, apply it to your own trading. I hope it does help you. And if you did find any valuable information from this video, please do me a favor and drop me a thumbs up. A subscription is always appreciated. And as well, if you do want to tell me something or have something you want me to say or go over, you can leave it down in the comment section below. But other than that, I hope you have a profitable day on and off the charts.